Hello, everyone. We're just going to give everyone a few minutes to log in, and then we'll begin at 1:02 Eastern Time. Give everyone a couple more minutes to show up, and we'll be starting in 2 minutes. Good afternoon or good morning, everyone, and welcome to our webinar. And we're glad to have you with us today. Today, we're going to talk about funding forward, moving our businesses to the next steps, and thinking about funding in that capacity. Please present and post your questions in the Q&A only. The moderator will take the questions after my prepared remarks, and we'll try our best to answer as many of them as possible. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com, and later in the day, we will also email a copy to participants. A little bit about myself. I'm Ami Kassar, the founder and CEO of Multifunding. I write a regular column for Inc. magazine. I've advised former administrations about the small business credit markets. I have a book out called The Growth Dilemma, and for my EO friends out there, I'm a member of EO Philadelphia. My lawyers asked me to read a couple disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. Multifunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. And we encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. Now that we are over that boring stuff, let's dig in. So many business owners I meet today and speak with are focused on survival instincts. Everyone is quite nervous and worried. There is a herd mentality around this. There's fear and anxiety, and quite naturally, coronavirus does produce fear. But crisis also invariably throughout history creates opportunities. And for each of us and in each of our businesses, opportunities will knock and different doors will open. And it is up to us, in my opinion, to start to think about and reimagine what is next for our business and what our businesses will look like going forward. For each of us, that is a different picture. This is a time to prepare for battle, because going forward and rebuilding and getting our businesses up and growing and running again is going to be a battle. For that battle, we each need a strategy. Are we going to tweak our businesses 5% or 90% or 50%? For everyone, it's a bit different. We need to decide who our core team is to take us forward. And we need to decide and think through what ammunition we need, or what cash, in this case, we will need to do the job. Cash will be required to get your business back up on a stable footing. What is the best case and worst case? And where will this cash come from, and how much are you willing to personally risk? These are some of the things I want you to think about as you consider the Main Street Lending Program. This program has $600 billion allocated for it. It will be in effect until September 30th, 2020, and it is comprised of 3 facilities: new, priority, and expanded. You will go to a bank, a savings association, or a credit union for one of these loans. This will not be like the PPP, where every bank and credit union in America was seemingly participating. We think there will be much more limited banks participating in this program. Eligible borrowers will be established prior to March 13, 2020. If your business has more than 15,000 employees or more than 2019 annual revenue of $5 billion, you're not qualified. And you have to be created or organized in the United States, with most of your primary operations in the United States. Business has to be constructed as a partnership, an LLC, a corporation, an association, a trust, a cooperative, a joint venture with no more than 49% participation by foreign business entities or a tribal business concern. You are a developer or a landlord, you're ineligible for this program, and certain other industries are ineligible as well. When you think about the affiliation rules, any companies that you control count. So you have to combine those companies and look at their total employees, their EBITDA, their debt, and their revenue. Let's begin by looking at the new and priority facilities. These programs share some things in common. They are a secured or unsecured term loan on a 4-year maturity. Principal and interest payments are deferred for 1 year, so you pay nothing for the first year, but unpaid interest will be capitalized in year 2, 3, and 4. They are based at an adjustable rate of LIBOR plus 300 basis points. The minimum loan size is $500K and the maximum loan size is $25 billion. Prepayment is permitted without penalty, and fees to get in the loan are between 1% and 2%. The new facility is between $500 and $25 million. What differentiates primarily the new facility between the preferred facility is that it really has to do with your existing lender's rights. For a new facility, the lenders have to have same or equivalent or higher rights in case of bankruptcy, but in the rest of the order of business, it doesn't matter what rights the lender has. And for a new facility, while there's no payments in year 1 and you start paying interest in year 2, at the end of year 2, year 3, and year 4, you pay down the loan by a third, and a third. How much are you eligible for? Let's take a company with 2019 EBITDA of $500,000. If you go in row 1, their not to exceed would be 4 times that, or $2 million. And if they have existing debt of $500,000, their potential new money would be $2 million minus $500,000, which would be $1.5 million. In row 3, if that same company had $1.5 million worth of existing debt, their potential new money would be $500,000. A very baseline example, a company with 125,000 of 2019 EBITDA and no debt could borrow $500,000. The priority facility is primarily different by the lender's rights and the amount of the loan you can get and the amortization schedule. On a priority facility, the lender's rights have to be senior or on par with all other lenders except for the mortgage. The payment schedule is 15% at the end of year 2, 15% at the end of year 3, and 70% at the end of year 4, which is more advantageous than the new facility. And let's take some examples of a priority facility. Same company as before, but in year row 3, if that company had $500,000 worth of EBITDA, their not to exceed would be 6 times that, or $3 million. If they had existing debt of $1.5 million, their potential new money would be $1.5 million. That same company in row 1, and if they had $500,000 worth of debt, could get a priority loan facility of $2.5 million. On a very baseline scenario, a company with 2019 EBITDA of $83,000 could get a priority loan facility of $500,000. Now let's talk about the expanded facility. Just to be clear, to be eligible for one of these, you have to have at least $28.5 million worth of debt. So if you don't have that much, we encourage you to save some brain cells and not think about this. These loans are similar, except the origination points are lower, and they serve as an extension on your existing debt. You can get up to 35% of your debt as an extension. So taking row 4, a company with $10 million of 2019 EBITDA and $100 million worth of existing debt, their not to exceed would be 6 times that, but 35% of their existing debt would be $35 million, so that's what they could get. What are the certifications and covenants that you have to agree to for one of these loans? You can commit to not using this money to repay the principal balance of your prior debt. You can use it to make old interest and required payments, but not pay it down. You commit not to reduce your committed lines of credit with your eligible lender or any other lender. And you have to certify that you have a reasonable basis to believe that your company is not going to go bankrupt in the next 90 days. You agree to certain restrictions on compensation and stock repurchases. There are some exceptions to these restrictions for companies that are tax pass-through entities, such as LLCs or S-corps. You agree for up to 12 months after the loan is paid in full and while you have the loan, not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you agree not to earn more than that any year while you have the loan and 1 year thereafter. If your compensation was in excess of $3 million, let's say $6 million, you take half the difference between 3 and 6, which is $1.5 million, add it to the 3, and you have $4.5 million. You agree to make reasonable efforts to retain your employees while you have the loan. However, I want to be clear that this is not like the PPP, whose primary focus was to save jobs. The primary focus of this loan program is to save and build companies. Your EBITDA will be calculated by the bank if it's a bank you've worked with before in the same way they have historically calculated your EBITDA for previous loans. And if you've not worked with them before, it will be the way they have calculated EBITDA for similar companies like yours historically. Debt will be calculated. Existing, outstanding, and undrawn available debt will include all amounts borrowed under any loan facility, including unsecured or secured loans from any bank, non-bank financial institution, or private lender, as well as any publicly issued bonds or private placement facilities. If you have an asset-based line secured by your accounts receivable and inventory, it won't be the total line size, it'll be the amount that you're able to borrow with your existing collateral. If you have a, let's say, what would you be able to pick? If you have a facility, a company with $2 million of EBITDA and existing debt of $5 million. Priority facility would be $7 million, and the new facility would be $3 million. So you would have to decide which one was for you and which program you would be eligible for. Financing strategy is very much like offense and defense. So let's take 3 examples that people are contemplating to use this loan program. One is a company with a $3 million line of credit and $1 million drawn against it. The line of credit has a personal guarantee. They are planning on getting an MSLP for liquidity. They would rather not personal guarantee the capital they believe is going to be required to reestablish their business. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. A third example is a company that is already being approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much money will be required to get your business back on a stable footing? What is the best case and worst case scenario? And where will the cash come from, and how much are you willing to personally risk? These are all questions that everyone has to consider. And as you reimagine your business and think about what it will look like in your future, what are your plans accordingly? I've now, multi-funding for those who are interested is available to help with the Main Street lending loans. On that note, I'm now going to ask the moderator to open up the floor for questions.
Thank you, Ami. The first 2 questions are asking where you should expect to find participating lenders for this program, and has anyone started the process for businesses who are ready to apply?
So lenders are not officially open yet, and most lenders have not officially announced yet whether they're doing it or not, because the final rules aren't out. So some of it will be when it is open, working around. We at Multifunding are starting to put applications together for our clients and talking to lenders so that when the doors open, we will be ready, but the doors are not open yet.
What about subordinated debt to bank? Does that count as debt?
Yes.
Concerning the prioritized loan facility, I assume the bank would still accept a payment in year 1?
You can prepay as much of it down as you want without penalty as you go along, just like a conventional term loan.
90K EBITDA, existing debt of 150K. What would be the loan amount under priority loan facility? Is 500K minimum after accounting for a current debt?
You won't be, but with those numbers, you will not qualify for the loan, unfortunately, because 6 times 90K is 540 minus 150. It takes you around 390, and that's too small a loan for this program.
Would a sale of my business within the 5 years of receiving a priority loan be possible? And if not, if it was on a note following the dividend rules, or could a receiver hold the money until the 5 years expired?
Well, it's not 5 years, it's for 1 year after you shut down the loan. So if you have the loan for 1 year and then you sell the business, I believe that would mean that you would have to put your proceeds in escrow for 1 year, but then you could take them out.
Has there been any updates or changes made to the priority loan program since your last webinar or in the last 7 days?
We watch every day for them, every few hours, and nothing yet.
Is our PPP loan balance included in that debt?
We believe it will be until whatever part of it is forgiven will be excluded, but for right now it will be.
Can a company accept an EIDL of 150K loan and still apply for the MSLP?
Should be no reason if you're qualified for the overall numbers of debt. However, when you sign up for that 150K loan, the government as a lender has a whole bunch of rights. And then you'd have to figure out how those rights are different or impact the rights of your MSLP lender, and that could be an issue. So it could be a problem for you, and as the government and the SBA will play along.
I have been approved for 150K SBA loan. Is the first 10K a grant?
Not necessarily. That's that's an EIDL question, and I'm not 100% sure, but I don't think that's necessarily the case.
Did you say priority is 6 times? And what constitutes priority versus new?
Priority is 6 times, and what constitutes it is what rights. If you have no other debt, you might as well get the priority. If you have other debt, you have to figure out what rights the lenders will agree to, which will constitute whether you should get the priority or the new.
Okay. Any more questions?
Any questions, folks? Okay. One more
I have a
question.
question. Yeah. Do you help find lenders?
We are, for our clients, correct, for the MSLP.
Yes. I have one more question. Sounds like the MSLP loan application will be more extensive than the PPP. So would be applying through the existing bank be even easier if it's a larger bank?
Again, that all depends on which banks are going to participate in the program. And if you have an existing relationship with a bank and they're doing it, and you have a good relationship with them and they know your file, that might be easier. But we don't know yet if your bank's going to do it or how they're going to do it or under what guidelines. The banks have more flexibility in choosing this program. It's not a vanilla program in the same way as the PPP is. Some banks might look at your EBITDA differently. Some banks might consider your negotiation with lenders differently. It's really going to be, there'll be a lot of variables in it.
Can you take out existing loan to make the new total a priority?
It's a little bit unclear about if you are able to do that, and we're waiting for further guidance on that.
Are payments due monthly or at the end of years 2, 3, and 4?
There are no payments for the first year, but at month 13, your first interest payment is due. And then at month 24, your first principal payment is due.
Okay, thank you so much, Ami.
Appreciate everyone. Be safe and well out there. Thank you so much. Take care. Bye-bye.
Bye-bye.